There is a number sitting in front of every silver investor right now, and almost none of them are looking at it correctly. Silver spent the first weeks of this year doing something it had not done in living memory, tearing through $50 an ounce, then 60, then 80, then climbing all the way to an all-time high above $120 in late January. And then it did something that most of the people who bought near the top never saw coming. It fell hard, down through 100, down through 80, down through 70, back to the high 50s where it sits today. If you only watch the headlines, you would think silver's story in 2026 was a story of a bubble that popped. But if you understand how monetary metals actually move through history, you know that is not the real story at all. The real story is quieter, slower, and far more consequential than a single dramatic spike. And by the end of this video, you are going to understand why the investors who panicked during that fall were making the same psychological mistake that gold and silver buyers have made in every major cycle for the last century, and why the structural forces underneath this market have not gone anywhere. Before we go further, I want to know something about you. Comment below and tell me where you're watching this from and whether you personally hold gold, silver, or cash right now. I read these and I want to understand who is actually sitting across from me in this conversation, because what I'm about to walk through applies differently depending on where you're starting from. Let's begin with the number that matters more than the price chart. Silver is currently trading in the high $50 range per ounce, and the gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, sits close to 69-1. Historically, whenever that ratio has stretched this wide, it has tended to precede a period where silver outperforms gold. Not because of speculation, but because of the underlying arithmetic of supply. That single data point is easy to skip past, but it is the thread that connects everything else we're going to discuss today. So hold on to it. To understand why silver behaves the way it does, you first have to understand what silver actually is, because most people only know half the story. Silver is not simply a commodity like copper or aluminum. It has always occupied a strange dual identity. For most of the last 4,000 years, silver was money, real circulating, legally recognized currency used across empires from Rome to the Ottoman world to colonial America, precisely because it was scarce enough to hold value and abundant enough to actually be used in daily transactions. Unlike gold, which was too rare and too valuable for ordinary commerce, that monetary memory does not disappear just because paper currency replaced metal coins in the 20th century. It sits in the collective psychology of markets, ready to reawaken whenever confidence in paper money weakens. At the same time, silver is now one of the most critical industrial metals on Earth, essential to solar panels, electric vehicles, semiconductors, and the data infrastructure powering artificial intelligence. No other metal on the planet carries both identities at once: a safe haven when trust breaks down, and an industrial necessity when the economy is expanding. That duality is precisely what makes silver's price action so much more volatile and so much more revealing than gold's. Now let's talk about why that duality has become so important in 2026 specifically. And to do that, we need to talk about the Federal Reserve. Interest rates are, in the simplest possible terms, the price of money. When the Federal Reserve raises rates, it becomes more expensive to borrow, which slows spending, cools inflation, and typically makes holding cash or bonds more attractive relative to non-yielding assets like gold and silver, because metals pay you nothing while you hold them. When the Fed cuts rates, the opposite happens. Borrowing gets cheaper, cash becomes less rewarding, and hard assets tend to regain their appeal. This year, under Fed Chair Kevin Walsh, the central bank has walked a genuinely difficult line. It left interest rates unchanged at its most recent meeting, even as 3 policymakers publicly dissented, arguing that inflation pressures were not yet defeated and further tightening was still needed. Markets are currently pricing meaningful odds of another rate hike as soon as September. That kind of internal disagreement at the Fed is not noise. It is a signal. When policymakers who sit in the same room looking at the same data cannot agree on the correct path forward, it tells you the economy is sitting in a genuinely uncertain zone, not a comfortable, obvious one. And uncertainty, more than any single policy decision, is exactly the kind of environment where investors historically turn to monetary metals. Layer onto that the inflation picture itself. The Fed's preferred measure of inflation has remained stubbornly elevated for much of this year, running well above the central bank's long-standing 2% target. Meanwhile, the physical conflict in the Middle East, particularly renewed strikes involving Iran, has kept oil markets on edge, and energy prices have a way of rippling through every other price in the economy, from shipping costs to manufacturing inputs to the price of a loaf of bread. When you combine sticky inflation with geopolitical instability that threatens to push energy costs higher still, you get a Federal Reserve that is boxed in. It cannot cut rates aggressively without risking another inflation wave. And it cannot raise rates aggressively without risking real damage to an economy that is already showing strain under the weight of historically high government debt. That tension, a central bank that is simultaneously worried about inflation and worried about growth, is precisely the kind of environment that has historically been most supportive for gold and silver, because both metals thrive not when things are calm, but when policymakers appear cornered. And this is where we need to talk about debt, because it is the foundation underneath everything else we've discussed. The United States national debt has now crossed $39 trillion. Interest costs on that debt now exceed $2 trillion per year, an amount that rivals entire categories of federal spending like national defense. The Congressional Budget Office projects structural deficits in the range of 5 to 6.5% of GDP continuing for the next decade, not as a temporary emergency measure, but as the baseline expectation. Moody's has already stripped the United States of its final untouched AAA credit rating, following similar downgrades from other agencies in prior years. None of this means the United States is at risk of a sudden default. That is not how sovereign debt crises in reserve currency nations typically unfold. What it means is something slower and in some ways more corrosive, a gradual erosion of the dollar's purchasing power as the government finds it easier to manage its debt burden through persistent moderate inflation rather than painful austerity. This is not a new strategy. It is one of the oldest tools in the history of sovereign finance, sometimes called currency debasement, and it has played out in nearly every empire that has carried excessive debt loads, from ancient Rome, which progressively reduced the silver content of its coins, to the more recent examples of the 1972 when the United States abandoned the last vestiges of the gold standard and inflation climbed into double digits. This is precisely why central banks around the world are not behaving like people who believe the current monetary system is stable and permanent. According to the World Gold Council's 2026 survey of the world's central banks, 89% of respondents expect their institutions' gold reserves to keep growing, a record level of consensus. Central banks have now averaged roughly 1,000 tons of gold purchases annually for 4 consecutive years, double the pace seen in the prior decade, with a record 45% of surveyed institutions planning to increase their holdings further over the coming year. Central bank buying continued into the second quarter of 2026 as well, with purchases reported at 289 tons, the strongest quarterly total of the year, led by countries like Poland and China, continuing to diversify their reserves. These are not retail investors chasing a trend on social media. These are the very institutions that issue and manage the world's major currencies, making deliberate long horizon decisions about how much confidence to place in paper money versus physical metal. When the people who print the money are quietly buying gold at a record pace, that tells you something important about how seriously to take the debasement story, regardless of what the day-to-day price chart is doing. Now, let's bring this back to silver specifically, because silver has a structural story layered on top of everything we've just discussed, and it may be the least understood part of this entire market. The Silver Institute currently forecasts a global silver deficit of roughly 46 million ounces for 2026 alone, and this would mark the 6th consecutive year that global silver demand has outpaced global mine supply. Since 2021, cumulative drawdowns from global above-ground silver stockpiles are estimated at more than 700 million troy ounces, an amount roughly equivalent to an entire year of global mine production. Unlike gold, which is primarily mined as a standalone product, most silver is produced as a byproduct of mining for copper, lead, and zinc, which means silver supply cannot simply expand in response to higher prices the way supply typically does in most commodity markets. Even if every silver mining company on Earth wanted to ramp up production tomorrow, the physical and economic realities of byproduct mining make that extraordinarily difficult to do quickly. Meanwhile, demand keeps climbing from sources that have nothing to do with jewelry or coins. Solar panel manufacturing, electric vehicle production, and the build-out of artificial intelligence data infrastructure all require meaningful quantities of silver. And none of those industries are positioned to reduce their consumption anytime soon. You have, in other words, inelastic supply meeting structurally rising demand. A combination that in almost every commodity market in history eventually resolves through higher prices, even if the path there is anything but smooth. Let me tell you about someone who learned this lesson the hard way and someone else who learned it the right way, because the numbers only tell half the story. Understanding the psychology of the people living through these swings tells you the other half. Consider a man named Daniel, 44 years old, an operations manager who had never owned a single ounce of precious metal in his life until January of this year. Daniel watched silver rocket past $100 on financial news and felt the unmistakable pull that behavioral economists call fear of missing out, a psychological state where the pain of watching others profit becomes more motivating than any rational assessment of value. He bought near the peak close to $115 an ounce using money he had originally set aside for a home renovation. When silver began its sharp decline over the following months, Daniel did not sell immediately. He held on checking the price obsessively, telling himself it would recover. But by the time silver had fallen back into the 50s, the emotional weight became unbearable, and he sold everything at a steep loss, telling friends that silver was, in his words, a scam for suckers. Daniel's mistake was not that he believed in silver. His mistake was that he entered during a moment of maximum emotional intensity without any understanding of the structural deficit or the historical pattern of volatility that monetary metals have always displayed, and he exited during a moment of equally maximum emotional intensity in the opposite direction. Now consider someone very different. A woman named Priya, 61 years old, a retired school teacher who began slowly accumulating physical silver coins back in 2019, long before any of this was making headlines. Priya never allocated more than a small defined percentage of her retirement savings to metals, and she added to her position gradually on a fixed schedule, regardless of what the price was doing that particular month. A strategy sometimes called dollar cost averaging. When silver spiked above $120 in January, Priya did not celebrate or rush to buy more. When it crashed back into the 50s a few months later, she did not panic or sell. She simply continued her existing plan, viewing the volatility as background noise around a long-term thesis she had already researched and committed 2 years earlier. Priya's outcome was not dramatic in either direction. She was neither devastated by the crash nor euphoric at the peak, because her strategy was never built around predicting short-term price movements in the first place. It was built around a structural view of monetary debasement and industrial demand playing out over a decade, not a quarter. And there's a third story worth telling because it illustrates a different kind of mistake entirely. A man named Marcus, 29 years old, working in software sales, decided in March, after silver had already fallen from its peak, that the crash represented his chance to get rich quickly. Rather than buying physical silver or a diversified fund, Marcus used leveraged trading products, borrowing money to amplify his exposure many times over, believing the deficit story guaranteed a swift rebound. Silver did eventually stabilize and grind modestly higher over the following months. And had Marcus simply held an unleveraged position, he would have earned a reasonable return. But the volatility along the way, the day-to-day and week-to-week swings that are entirely normal for this asset class, triggered margin calls that forced him out of his leveraged position at a loss before the recovery had a chance to play out. Marcus was actually right about the long-term direction. His mistake was structural, not analytical. He used the tool designed for short-term speculation to express what was at its core a long-term thesis. And the mismatch between his tool and his timeline is what destroyed him, not his reasoning. These three stories are fictional, but they represent patterns that repeat constantly in every precious metal cycle throughout history. And understanding why requires understanding something about how the human brain is actually wired, not just how markets are wired. When people watch an asset price rise rapidly, the brain's reward circuitry centered in a region called the ventral striatum releases dopamine in anticipation of further gains, not just in response to actual profit. This is the same neurological mechanism implicated in gambling behavior, and it explains why rising prices generate a compulsive, almost addictive pull to buy more precisely at the moment when an asset is most expensive and statistically least likely to offer a good entry point. Conversely, when prices fall sharply, the brain's threat detection system centered in the amygdala triggers a fear response that is neurologically similar to physical danger, even though a falling stock or commodity price poses no immediate threat to survival. This is why investors so often report feeling physically unwell during sharp drawdowns, a racing heart, disrupted sleep, difficulty concentrating, because the brain is not distinguishing between a market decline and an actual predator. Evolution built us to respond to acute physical threats with immediate action, fight or flight, but financial markets require the opposite response, patience and calm reasoning, precisely the mental state that fear chemically suppresses. This mismatch between our evolved psychology and the demands of long-term investing is not a personal failing. It is a universal human vulnerability, and the only real defense against it is having a clear, predetermined plan before volatility strikes, so that decisions are made by a rational, forward-planning brain rather than your reactive, fear-driven brain in the middle of a stressful moment. Before we go further, if this kind of analysis is helping you see the bigger picture more clearly, take a moment to like this video and subscribe, because the final section of this video is going to tie together everything we've discussed so far. The Fed, the debt, the central bank buying, the supply deficit, and investor psychology into a single conclusion that I think is more important than any individual data point we've covered. Stay until the end, because it changes how the earlier information should actually be applied. Let's now turn to the geopolitical layer, because it interacts with everything we've already covered in a way that's easy to underestimate. The ongoing conflict involving Iran and renewed strikes against Iranian targets have kept global energy markets on edge throughout much of this year, and history shows a consistent pattern during periods of heightened Middle Eastern instability. Oil price spikes that ripple into broader inflation, combined with a flight toward assets perceived as safe from both currency risk and geopolitical risk simultaneously. Gold and silver benefit from this dynamic in a way that most other assets do not, because they carry no counterparty risk. When you hold physical gold or silver, you are not relying on a government, a bank, or a corporation to honor a promise to pay you back. That characteristic becomes disproportionately valuable during periods when trust in institutions, whether governments, currencies, or financial systems, comes under strain. We have seen this pattern before during the 1970s, a decade marked by an oil embargo, double-digit inflation, and a collapsing Bretton Woods monetary system. Gold rose from $35 an ounce to over $800 by 1980, while silver, driven partly by genuine monetary demand and partly by the now famous attempt by the Hunt brothers to corner the market using enormous amounts of borrowed money, spiked to nearly $50 an ounce before collapsing violently when exchanges changed margin rules and the debt-fueled buying unwound. That collapse is instructive because it shows that even a legitimate long-term monetary thesis can produce a devastating short-term crash when speculative excess and leverage get layered on top of it. The parallel to early 2026 is not perfect. No historical parallel ever is. But the underlying lesson that monetary metals can experience both structurally justified long-term appreciation and violently unstable short-term price action simultaneously is exactly as true today as it was in 1980. It's worth pausing here to explain in plain terms what a bond market actually is and why it matters so much to this entire story, because most people hear the phrase and assume it belongs to professionals, when in reality it quietly shapes almost every price you see in the economy. A government bond is simply a loan. When the United States government spends more than it collects in taxes, which it has done consistently for years, it borrows the difference by selling bonds to investors, promising to pay that money back with interest over time. When investors lose confidence that a borrower will responsibly manage that debt, they demand higher interest rates as compensation for the added risk, the same way a bank charges a higher rate to a borrower with a shakier credit history. Higher interest rates on government debt mean higher borrowing costs for the government itself, which means an even larger share of the federal budget gets consumed simply servicing existing debt rather than funding anything productive. This creates a feedback loop that becomes progressively